To give you an example, just like your candle patterns, let's say if you have a bullish engulfing, so you know what all criteria are to be checked to enter into a trade. Or let's say if you have a hammer pattern, you know what all criteria are to be checked to get into the trade, or what all things need to be avoided to avoid the trade. All right. Similarly, breakout patterns are the same thing. There are set conditions or set criteria that are there that you may need to follow. If you don't understand these things, again, it's nothing complex over here. But let's say if you don't want to mug up anything over here, it's okay, because it is, as I said, nothing but your market structure followed by a support and resistance levels. Just that we are looking at a few patterns, just like your candle patterns. Alright, so let's get started with this. Now, overall, the patterns are classified into two groups. One are known as unidirectional and one are known as bidirectional. Now, the difference between the two is that in the unidirectional group of patterns, the direction of the breakout is certain. हमें पता है कौन से direction में breakout होने वाला है. Is it going to happen? Will there be a breakout or will there be a breakdown? So in unidirectional, that is something which is certain. However, in bidirectional, you generally do not know where the breakout will happen. Will it be a breakout or will it be a breakdown? You do not know. Yes, of course, I'll be showing you a few tricks through which you can make certain estimates. But again, that is nothing which is concrete. It's just certain estimates basis which you can take a trade. So let's first start with the unidirectional patterns. And just like your candle patterns, you have names attached to the patterns given over here. So name of the first pattern that I'm covering with you all is the head and shoulder pattern. Let's see how does this look like. So there will be an existing uptrend. Market will form a top, correct from there. Market will again form a top, correct from there, and again market will form a top and correct from there. So this is known as your head and shoulder. This level over here, from where the market has been bouncing, is known as your neckline. Neckline. Now over here, the right peak is known as the right shoulder, top peak is known as the head, and the left peak is known as the left shoulder. So this is just the basic anatomy of the head and shoulder. Now let's try to understand a few important points over here. Now, one of the most important points is that it is not important that the height of the left shoulder and the right shoulder should be exactly the same. Plus minus a few points is absolutely okay. It's just that the head should be taller than the left and the right shoulder. Secondly, now let's speak about the volumes. How does the volume look like in a head and shoulder pattern? So in case of this first leg or the uptrend, the volume will be high. Now in this downtrend, can someone tell me what the volume should be? Low. So in the second leg or this downtrend, the volume should be low. Why? Because that is what? The secondary trend. Now since the volume is low, this is what? A sell-off in the market, but a secondary trend. Will we play the secondary trend? Will we play in the second leg over here?
No.
Or will we short the market over here? No. What will we do? We'll wait for the bottom and there we will go long. Now in this leg, how will the volumes be like? Or what is your estimation? How should the volumes be? High. Now, this is the difference in case of a head and shoulder. In this case, though the volume should have been high, but it is not high, rather it is low. Raising a red flag, or in other terms, an early warning signal that something is not right and probably the buyer's strength is decreasing. Though the market has formed a higher high in this case, but volumes in this uptrend should have been high, but rather they are low, raising a red flag. Similarly, in this downtrend, the volume should have been low, but what is happening now is the volumes are increasing. So through these two legs, can you come up to some conclusion? Are you all understanding how there is a shift from buyers to the sellers through volumes or volume analysis? Is this point clear to all? There is a shift from the buyers to the sellers. Is this point clear to all? Yes or no in the chat? Martha, just give me 2 minutes. I'll repeat the entire thing again. So there has been a shift from the buyers to the sellers. Now tell me, in this fifth leg, how should the volume be like?
Low.
Low. Again indicating what? That the buyer's strength is low. So the volume in the fifth leg will be low. And finally, in the last leg, which is by far the most important leg, the volume should be high. Not only should the volume be high in the last leg, but there should be good momentum as well. What do you mean by good momentum? That means when there is a fall, there shouldn't be multiple halts over here. It shouldn't happen like this. It shouldn't go sideways, then fall, then again go sideways, come back up a little, go sideways, comes back down, something like this. Now this is bad momentum. If it's coming down, it should come down with good momentum. So let me repeat what I've covered till now. As I said, overall we have two groups, unilateral and bilateral. Unilateral, we know that the direction of the breakout or the breakdown, but in bilateral, the direction of the breakdown or breakout is not certain. So we are starting off with unidirectional, and over here we have the first pattern, which is known as the head and shoulder, which looks like this: an existing uptrend, market forms a top, then a bottom, then a top, again a bottom, which is constant, then a top, then a bottom. About the volume analysis, in the first leg, the volume will be high, indicating that the buyer's strength is good, or there are sufficient buyers in the market. In the second leg, the volumes will be low, indicating that the sellers are not there or not present. In the third leg, the volume should have been high. Because the market has made a higher high, the volume should have been high, but in this case, what happens is the volumes decrease, indicating that the buyer's presence is decreasing, raising a red flag for us. And in the fourth leg, the volume for the sellers of this downtrend is increasing, indicating a shift of the strength from buyers to the sellers. Finally, in the fifth leg, the volume will be low. And the last leg, which is by far the most important leg for our analysis, not only should the volume be high, but there should be good momentum as well. Now let me ask you all a question. You know what is said that till the time the pattern is resting on its neckline. Now till now we have not spoken about the breakout or the breakdown. It is said that till the time the pattern is resting on the neckline, the pattern is not complete. Let me repeat the statement. Till the time the pattern is resting on the neckline, we say that the pattern is not complete. Can someone justify the statement? Why? Why do we say that?
Because neckline is where again and again buyers will
go back from the support.
Neckline is where
it can go back from the support
again and again.
Okay. Anything else?
It's a bearish pattern, so it has to break the neckline.
Not necessary.
Market structure changed from higher high to lower high.
Almost there. All right. Perfect, Rohit. So let me tell you the reason. Let me tell you the reason. Now let's come back to our yesterday's topic, the market structure. All right. What is happening? Till our head was formed, what was happening in the market? The market was forming a higher high and a higher low. Agreed? Indicating what? A bullish trend in the market. So what we were doing is we were buying the dips. So this is one entry where we could have gone long. Now after the head was formed, what has happened after that? The market ended up forming a constant low. So what is this indicating? Probably there is now a shift in the structure. Agreed? If the market wanted to continue its bullish pattern, what would have happened? The market would have again formed the higher low and continued its pattern on the upside. But that did not happen. Rather, the market formed a constant low. So now what is happening? It is indicating that probably the market is trying to shift its structure. Now, is it true that the market is immediately shifting its structure to a bearish market? At this point, can I say that the markets have become bearish? Why? Because market structure are of three types: bullish, bearish, and sideways. So at this point, I'm not certain that the market is in a downward direction. It could also go in a sideways direction. Now, after this, what has happened? After this, market has ended up forming a lower high. Agreed. But again, at this point in time, has the market yet formed a lower low? No. So can I still say that the market has gone into its bearish trend? Not yet. What if the market reverses from here and stays in a consolidation zone? That is also a possibility. So that is why till the time my head and shoulder is resting at the neckline, we say that the pattern is not yet complete. However, once we get this breakdown, now what is happening? Now isn't my lower high, lower low structure completed? Yes or no? Now once we get the breakdown, is it my lower high, lower low getting completed? Yes. That is why we should always wait for a breakdown in this case and never be early in the trade. Okay, now again, this depends on what sort of a trader you are in the market. If you are someone who is a little bit of a risk seeker, you will short the market immediately over here at the first lower high. If you are again a person who wants to take aggressive risk, you will short where? At the breakdown. But as per a market structure rule, where will we short? If you want to take the safest entry, where will we short?
Retest of neckline.
Retest of neckline, or let the market form a lower high after the breakdown. Is this point getting clear to all? Yes. So again, you can see this pattern is nothing but a shift in the market structure. Or kuch bhi nahi hai. Till date, everyone or those who have studied certain technical analysis, they must have learnt about head and shoulders. It gives a breakdown. But till date, you did not know why does it give a breakdown. But now you know why. Now over here, let's talk about the people who want to take some sort of a risk. So at the breakdown, what do I want? At the breakdown, I want high volumes. Volume should be high during a breakdown or a breakout. Moreover, the trader can also apply a strategy which is known as time filter or price filter to safeguard himself to a certain extent. Now, do you all know about the concept of price filter and time filter? Has this been taught to you ki nahi? Alright. Let's just quickly cover that. Now, what is a price filter and a time filter? This is no tool. This is no setup. This is just a strategy to safeguard yourself. Okay, an idea to safeguard yourself. So what happens is, let's say Nifty is at 17,000 and you are a person who trades breakouts. And as I said, 77%, yesterday I mentioned 77% of the breakouts fail. So how do we safeguard ourselves from the false breakouts? So there comes in the concept of time filter. What happens is, let's say that the market has given a breakout. Now what you as a trader do is, you do not immediately take the trade, or you do not immediately trade the breakout. Rather, you wait for some time and observe if the breakout is sustaining above that level for a certain period or not. If it is able to sustain above that given level for a certain period, let's say 40 minutes, now it is you're confident that all right, people are genuinely willing to take the markets up, and it's not just a false aggressive move, or it's not that there's a pump and dump case, or the vice versa, dump and pump case. So now you're a little bit confident that there are buyers in the market trying to push the markets up. So you waited for some time and now you took a trade. So basically, you're creating a time buffer for yourself. At 40 minutes, 45 minutes, you're observing the market and you are waiting, seeing if the breakout is sustaining or not. If it is sustaining, then only you are taking the trade. So this is something that we usually do during a very high volatile market, a very high uncertain situation. So let me give you an example. This happened when the US presidential elections were there. I think Nifty at that time was around 15,200 or 300. I don't exactly remember this right. But at that given point in time, on an intraday front, the Nifty had given a breakout. So many people were trying to go long over there, and that is where we advised rather put in a time filter. Let's see if the markets sustain above that given strike price for at least 1 hour. If it does, only then we will take a trade. Luckily, the markets did not sustain over that given strike price, and within 15 or 20 minutes, the markets were back down again, giving that breakout a false breakout. And luckily, because of the strategy, many traders got saved. So is this point clear to all about time filter? Yes or no in the chat? Now let me ask you all a question. Let's say that the uncertainty is very high. So if the uncertainty is very high, will you keep a lower time buffer for yourself or a higher time buffer for yourself? Any time frame, does not matter. Higher time. Alright. So if the uncertainty in the market is increasing, so now what you will be doing is, instead of let's say waiting for 1 hour, now you will be waiting for 3 hours just to see and observe that the market is sustaining above that given level. If it is able to sustain above that given level for let's say 3 hours, now it shows some sign of strength, it shows some sign of genuinity, and only then will you take a trade. So this is your concept of time filter. However, there is a small drawback over here. The drawback is, what if at the time of breakout itself, the breakout was genuine? So isn't there a possibility that the market will just run up and you will miss out on the entire trade? Yes. So to safeguard yourself from that move, we also apply something which is known as a price filter. Now what is a price filter? Again, it is same. Again, 17,000 important resistance level on Nifty. So technically, till date, what we all were doing is breakout happened, let's take a trade. But now, what you could alternatively do is, instead of immediately taking a trade, you create a price buffer for yourself. Matlab, you say that I will not take a trade as soon as 17,000 breaks. I will rather wait for 17,200 to break. Only then will I take a trade. You are creating a 200 point buffer for yourself. You're not interested in playing this 200 points just because you want to safeguard yourself. So now what you're saying is 17,000 is the major important resistance level. However, there is a risk of a false breakout. So what you will do is, once if the market has gone above 17,200, only then will I consider taking a trade. Because now people are way above my resistance level and there is a very less possibility of this being a false breakout. So is this point clear? So it's an either or situation. Let's say if it reaches 17,000, sustains above that for let's say 1 hour, you can take a trade, or within that given time frame, if it breaks that 17,200 mark, then again you can take the trade over there. Now for time filter, it is subjective, depends on the uncertainty. You cannot, there's no method through which you can define ki I have to wait for this much time and then I'll be able to take a trade. That is subjective. However, for a price filter, there is this indicator which will be taught to you, which is known as ATR, average true range. So once this will be taught to you, you will understand how this breakouts of yours becomes a little more secured, but still it will be a highly risky trade to take. It is always better to take a trade through your market structure. Is this point clear to all? Yes or no in the chat? Is time filter and price filter clear to all? Any doubts?
Sir, in case of intraday, like we can't have a range of 200 points in case of Nifty. If a breakout comes, then how come
As
we
I
use
said,
that time
through
filter?
ATR, wait for this ATR concept. So for intraday ATR will be different, swing trading ATR will be different.
Okay. Because what I do is I simply only trade a breakout when, for example, 17,000 is broken. I only take a trade about 17,050.
So again, to make things much more precise, it's better you use the indicator.
All right. Thank you.
Himayal, when we talk about the time filter, what should be like the ideal? I don't think there's some ideal time frame as such, but what minute should we see? Like a 15-minute candle close or higher? What could be?
See, again, it depends on what sort of a time frame you are trading. If you are someone who's an intraday trader, and let's say that there's a moderate uncertainty in the market, then we wait for generally 30 minutes to 45 minutes. But if the uncertainty is very high, then we might even wait for 2 hours, 3 hours. It depends. So yeah, closing of course is an important aspect, but all we need to see if it's sustaining above that level or not. That is the main objective that you need to take in this case. As I said, time filter is subjective.
Like if you see today's market, 17,000 levels were not reached from the downside. And it kept on coming to that level again and kept on bouncing back from there.
So again, over here, false breakdown. So over here, what has happened? Let's say 17,000 mark is broken on the downside. Many people would have immediately gone short, but rather what you could have done is you could have said that let me wait for 45 minutes. If it sustains, only then will I take a trade on the downside. But did it sustain? No. Good thing we did not short the market over. It was false breakdown, markets came back up. Point clear?
Yeah, but then if you miss out on it, then that could be you miss out, right? Because
yeah, you miss out. See, again, it's better to be safe than sorry. So we never chase the market. Never chase the market. If it's gone, it's gone. Does not matter. Rather, what you could do is a better approach. Let the market give you that lower high. Since morning market was giving you that lower high, again in this case also let it give you that lower high. Only then you go short. Else avoid it. If it's gone in a single shot, does not matter. You're not here to chase the market.
I had a question. Yesterday you said that we wait for in intraday we wait for 45 to 50 minutes before taking a trade and to form for the structure to form. Then today, how would you have traded if that was the structure? Low high.
Here by 10 o'clock, you can see already market started creating a lower high. हो गया 45 minutes 10 o'clock के आसपास.
So we could have gone short there, right?
Yeah, inside candle breakdown over here.
Got it.
Alright, I'll just take a couple of questions from the chat as well. Price filter, please repeat. So Abhishek, it's simple. If let's say there's a major resistance level, it breaks. Now you want to make sure that the breakout is genuine and it's not a false breakout. So what you do is you